Hi there everybody, we're going to talk today about sustainable investing. Now this is a theme that has really grown in prominence over the last decade, and it's now something that is front of mind for many investors. We've really got behind that as a firm, and we've put a lot of effort and energy and resource into trying to get behind sort of the companies that are doing the right thing and educate our clients about where they can invest to ensure that their portfolios are aligned with their own values. So I'm joined today by Roy and Vanessa. Welcome, thanks for coming along. And we're going to talk a little bit about sustainability and some of the challenges, some of the opportunities, and how investors can really make the most out of some of the material that we've been putting together. So look, I just kind of want to start by defining sustainability. There's a lot of terms that get thrown around: ESG, SRI investing, sustainability. Maybe I'll start with you, Roy. How do you sort of wrap up sustainable investing in a nutshell?
Well, sustainable investing at its simplest is, historically we've looked at a company's performance on financial measures, mainly, the profitability. That's been the most important things. The whole sort of nexus of sustainable investing is to look at, the things around that, the non-financial measures, be it, emissions or, how they're treating their employees and governance. And that's just increasingly seen as, a really important driver of value and also just, really important for people to want to invest in line with their values in companies that are operating sustainably. So there's various ways, there's a lot of terms. You mentioned ESG, SRI, there's a lot, like most things in finances, there can be a lot of jargon that we, try and break down. But simply put, the two most common ways of doing it are negative screening, where you basically exclude a bunch of companies that might be operating in sectors like fossil fuels, or they might conduct animal testing, testing on animals for things like cosmetics or gambling or tobacco and things like that. And then there's ESG, which is environmental, social, governance, and so you're taking a more holistic view, looking at a company, looking at them against a range of factors under those criteria and assessing, how well they're performing, their sustainability credentials, essentially. And so you're looking at companies that would be screened out, so the bad companies, and seeing actually are some of those bad companies doing really good, and can we support that? And then you're also looking at companies that you might not suspect, maybe there's issues in the supply chain or emissions and things like that. So you're looking at all companies and trying to just gain extra intel to make an investing decision.
So we've looked at all of these companies on all of these issues, and we've judged them on all of those, and then written up why we've got to the answer we've got to. Is that in a nutshell, Vanessa?
Yeah, so we've looked at, broken it down into the three areas of the environmental, social and governance side. We've looked at all the criteria and then tried to put in this one-page summary for clients to use, the main considerations that they should look at when making an investment decision.
So, just kind of big picture from an investor's point of view, I guess we want to put our capital behind businesses that are doing the right thing, because we just want to support those that are good corporate citizens, for lack of a better phrase. But does it impact people's returns? Is it beneficial in a financial sense? And I guess there's that myth out there, well, I don't know if it's a myth, do you have to sacrifice your returns to invest sustainably, or can it add to your potential returns? Do we know? Is it measurable?
Yeah, there's been a lot of research into this area, but it's hard to definitively say that it does. If anything, it leads to outperformance. That's what the evidence indicates, but it depends on sort of what type of sustainability you're measuring. Is it, are you just excluding companies, or are you incorporating the leaders? And often, if you look at, for example, an exchange-traded fund, they'll have a higher sector weighting towards healthcare or technology, for example, which tend to have higher performing companies than in energy or utilities, for instance, especially offshore. And the last few years, especially with interest rates falling and some other sort of factors at play, those sectors have outperformed. So a lot of sort of ESG funds have outperformed. But yeah, at the very least, it doesn't. We don't believe negatively impact performance, and that makes sense if you think about, our ethos as Craig's is to invest in quality companies, and we believe quality companies outperform over the longer over the long term. You know, they have higher returns on reinvested capital, which is really important for us. And high quality companies tend to be managing sustainability related risks much better. So for example, from emissions, you know, changing regulation, changing you know, consumer demand patterns, wanting to buy cleaner, greener products, and also, you know, investor change as well. So, you know, high quality companies are a bit further along on that sustainability curve. So, yeah.
So I guess over the short term, it's quite hard to gauge whether you're going to do better or worse, isn't it? But one would think that in the longer term, if you're acting in a way that's more sustainable, you are going to retain customers or win customers. You're going to have happier staff. You're not going to find yourself in the firing line for government regulation and increased costs and all of those sorts of things. So even if over shorter periods of time the jury's out, one would think it stands to reason that those that are running their businesses in a more sustainable way will definitely be better performers over the long term. Would you agree, Vanessa?
Yeah, I definitely agree on that. I think as an investor you're going to look towards where trends are kind of heading towards and then put your money there.
The other really important point is that, so it's investing in line with your beliefs and your values, potentially investing in high quality companies that will outperform, but also sending a strong signal to companies.
Yeah.
You know, so this exercise and this rapid growth in sustainable investing is getting through loud and clear to companies. If you look at disclosures from even 5 years ago compared to where they're at now, it's night and day. Or the, you know, the issues that we're talking about with companies now versus 5 years ago are a lot different. Sustainability is well and truly on the mainstream agenda. You know, more and more, you know, bigger sections in the annual report, for example, or presentation slides to investors will start with sustainability for, you know, certain companies where that's a key issue. So, yeah, there's a bit more to it.
You just didn't even see that 10 years, even 5 years ago, you didn't see that, did you? So it's absolutely gathering momentum. Well, let's talk about sort of how you actually assess the companies. Now, it's harder than it looks, isn't it, to sort of make those judgments, and talk us through how do you actually measure them, and thinking about the E and the S and the G, which of those is sort of easier versus more difficult to actually benchmark a company against?
Yeah, so we've come up with a framework where we have a lot of questions that we look at for the environmental, social and governance side. So we basically go onto a company's website and have a look through any of their annual reports, sustainability reports, or just anything that we can find on the internet. And then we'll go through and answer all these questions. And at the moment, on the environmental side, it's quite easy to see kind of quantitative data on that. You've got your emissions, which is clear, it's a number that's there for use. You've got water use, you've got waste that's being disclosed. On the social side, it's a little bit tougher because you're trying to gauge, you know, how involved in the community a company might be.
Yeah, there must be a lot more guesswork with that though, because it's not just a specific number that you can point to with your carbon footprint.
Yeah, and every company seems to be measuring this in a different way.
Yeah.
Also on the social side, you can look at the supply chain. So there might be metrics around how many supplier assessments they might be doing, but it's trying to gauge how seriously they're taking this and how far they're going to take it.
Yeah, and you're obviously needing to go and engage with management teams and boards of directors to, I guess, give them an opportunity to respond to the way that you might have judged them or scored them. And how are you sort of finding that engagement or that sort of attitude from those management teams and boards? Are they quite open and quite keen to do this work, or is there a bit of apprehension?
So we found it a bit better when we actually engage with the company earlier on in the process, rather than giving them a final score. If we don't understand something that we've read or we need more information, we'll go straight to the companies, and we've especially focused on the New Zealand companies here, gone straight to them and asked them the questions, and they've been happy to come back to us and give us more information. And yeah, so far they've been really well received. I think that we're doing this.
It's been positive. I also think there's a realisation amongst, you know, executives that this is a trend that's here to stay. It's increasingly on the radar of investors, and they want to do their best to make sure that they're providing the right information to the likes of us, so that we can make an informed decision for our clients in terms of how the company rates.
So, yeah, that's sort of where I was going with the question. I'm interested to know if you're seeing an increasing level of acceptance or acknowledgement that this is important and they need to focus on it more than they have in the past. So can you sort of feel that building, that it is getting more attention and more time and energy at the company level? These issues are getting debated around the board table to the degree that they should?
Yeah, for sure. You'll see more, active, top-down change within companies. Issues like emissions, for example, you just can't ignore it. So for example, we've been talking about, the investors driving change, and I guess that's from the bottom up, but from the top down, the environment that companies are facing is changing a lot. So for example, in New Zealand, all NZX listed companies will have to disclose their emissions, what they're doing to manage their emissions, potentially what risks there are as a result of climate change, including a scenario analysis, and this all needs to be signed off by the board, so it's a must-do now.
That's really interesting. And just thinking about the New Zealand environment, because you've obviously looked at a lot of the companies in New Zealand on our share market, as well as Australia and the US and Europe and everywhere really. So how do we stack up? Are we ahead of the curve, behind the curve when it comes to, I guess, thinking about these issues and just having an awareness as well as the disclosure? Because we're a smaller market, our companies aren't as big as some of these multinationals overseas that have plenty of people and plenty of time and deeper pockets to deal with it. So where do we rank?
I think it's fair to say that the disclosure from large, American and especially European companies are ahead of New Zealand. Even Australia would be ahead of New Zealand. That's a function of size and resource.
Yeah.
So, our largest company, Fisher & Paykel Healthcare, would be, a small to medium cap in the US. So the resource is just there, and it's, the market for sustainability investment products is just a bit more advanced in the US and Europe. But on the other hand, the risks that some companies in New Zealand face are lower. So if you think about on the social side of things, supply chain responsibility, comparing the supply chain of Apple versus comparing the supply chain of Meridian Energy, it's just night and day. And so you'd expect, because it's such a higher risk factor, that Apple, they have to, we've seen companies like Nike in the past, or even Apple in the past, have issues around supply chain responsibility, potential human rights violations. So it's just a bit more evolved. But we do this ourselves in terms of our house. We're not sort of relying on outside data sources, so we can take a bit more pragmatic, common sense approach and a risk-based approach as well. We know these companies, we've been researching these companies for decades in some cases, and can sort of come to a end result that is reflective of where we think they actually are, not simply a fact of do you have this policy, do you have that policy. So we think that's much more powerful and useful.
Yeah, because we haven't just sort of bought an off-the-shelf sort of rating system from some overseas outfit, have we? We've rolled our sleeves up, got in there, done the work, and brought to our customers a product that is much more sophisticated and we think is actually going to add much more value to them when they're making these decisions, haven't we?
Yeah, so earlier on in the piece we did look at trying to get something off the shelf. But we found, as we were looking at the different companies, they scored the companies quite differently. So it's very hard to make sense of what was kind of a true score. And also within the companies, within the sectors, they would rank them. So you're still getting the best oil and gas companies, getting an A+ score. Whereas we've tried to broaden it and look across all the sectors and kind of, flatten the playing field, really.
Yeah.
And we think it's the information and the work that we've done that's more important than the score. The score is a good starting point, a reflection of what we see, but we really think the most useful bit is our plain English summary that anyone can read of the key issues. Why we've given XYZ company the score on the E side, why we've given it the score on the S side and the G side, and that ultimately enables the individual investor to be the decision maker, which is something we believe strongly with, because it's very subjective, and different people obviously have different beliefs and values, and at the end of the day they need to be happy with their portfolio.
Yeah, and that's really important, isn't it? Because I mean, as a firm, we've never been about one-size-fits-all solutions. We've always been about tailoring portfolios and solutions to clients, because all our clients are different. And this is a perfect example, isn't it? Because you ask 10 people about what does sustainability mean to them, you get 10 different answers. You know, some people it's all about climate change, others it's, you know, they're focused on sort of, are you treating your staff well? Others it's sort of board diversity. You know, everyone has completely different sort of values and objectives that they're trying to align with. So that's a bit of a challenge, isn't it? That, you know, people all think about sustainability a little bit differently.
Yeah, I think that is the beauty of what we've done. It does give the investor the choice to choose what's most important for them.
But it also makes it hard to just sort of give a company a, you know, A, B, C or D score when, you know, people are going to sort of take different views. So
well, I suppose like when we've written the summaries, we're just trying to flag what we think is most important, but putting all the information out there for the investor to actually choose it themselves.
Yeah. Well, let's talk about a few specific companies. You know, you've obviously been through this process and you've looked at sort of environmental issues and social issues and governance issues, and you've talked to boards and management teams, and you've turned over every rock that there is to turn over and trawled through news reports to find examples of companies maybe sort of finding themselves in the media for the wrong reasons. If I asked you to sort of, I'll put you on the spot, if you had to sort of think about a couple of companies that have, you know, maybe really stood out to you in a positive way, you know, maybe because they, you know, geez, these guys are really going above and beyond, or maybe it's a company that you might have not thought that they were going to score well, you know, on the face of it, and they actually surprised you. Any come to mind? You know, maybe in New Zealand one or two, and something sort of from some other part of the world. Any that spring to mind immediately as superstars?
Well, I think most recently I've looked into Fletcher Building, and so they do have a high emissions footprint within New Zealand. But when I've looked through the report and talked to them about it, we can see that they've got clear actions in place to reduce it. They know exactly where these emissions are coming from. And they've got this clear path as to how they're going to achieve this reductions target, which I think's been really cool to see.
And an example of that is they're the only company in the NZX 50 that we've looked at that has emissions explicitly included in executive remuneration.
Yeah.
So, you know, like health and safety is reasonably common to see, and health and safety kind of went through what ESG is going through, or sustainable investing is going through today, in terms of, you know, trying to improve health and safety outcomes. We're trying to improve sustainability outcomes now. So you'll see health and safety reasonably common in executive remuneration, especially where it's a risk, you know, miners, for example. So we'd hope that we'd see, you know, emissions in particular sort of start to creep into some of those incentives. And Fletcher Building's one of those. So the executives of their two largest emitting businesses, being cement in Australia, have that included. So that's encouraging. Another example is...
Let's talk about Fletcher. So that's a really interesting one. So Ross and the team get a big tick. They'll be happy to hear that they're doing the right thing. But you've touched on something really important there, is that this is a company where just the nature of their business is one that is just going to have those negative externalities or whatever term you want to use, isn't it? That's just the nature of the type of business they're in. So, you know, that's a case of where, you know, rather than sort of just picking on them and sort of saying, let's rule them out because this is the game that they're in, you've actually said, well, hang on, it's not all just about the fact that this is your industry. It's about identifying what are you doing to do things better. So that must be something that comes up, you know, back to that subjectivity, isn't it? Because there'll be lots of industries where the industry you're in, you're an emitter, or you're going to be doing something that has a negative impact that's unavoidable. So we're not just dogmatically, you know, crossing them out, are we? We're sort of actually getting in there and trying to figure out, well, are you doing it a better way though?
Well, yeah, I mean, another example would be Genesis Energy. They're obviously a high emitter within New Zealand, but they play an important part of the decarbonisation of the economy. So we can't just rule them out straight away because they're helping us keep the lights on in the interim. But again, you know, they realise that they're a high emitter. They've got an emissions target in place. We just see they're taking positive steps towards addressing this.
And I guess that engagement and this whole, you know, the fact that we're sort of putting sunlight on some of these examples helps sort of push that along, doesn't it? Like we're better to actually engage with these businesses and tell them what we want to see, what our investors and customers want to see, and speed up that process for the greater good, rather than just, you know, ruling out a whole bunch of industries because on the face of it they...
Yeah, that's the beauty of the approach. Yeah, able to send a positive signal, if anything, to these companies where, you know, Genesis is the highest emitter of all companies we've looked at in terms of relative to its revenue. It's got a very, very high emissions intensity from Huntly and burning coal. If they can halve their emissions, for example, which they can do, their target is to stop using coal at Huntly from 2030 and to not use it for anything other than you know, dry year risk from 2025. That could be sort of equal to all the other emissions reductions that all other companies achieve combined. So being able to send that signal that, you know, not just putting them to the side, but it's just a lot more powerful. Another example, you know, the Chinese power generating sector, which largely uses coal, is responsible for something like 15 or 20% of global emissions just by themselves. And so we best to just exclude them and just leave them to do their own thing siloed away, or to actually, you know, try and encourage them to drive change. And yeah, we just think it's a little bit more nuanced than just, you know, bad and good.
Yeah, that's great. So Fletcher Building, Genesis, really good examples there. Any from outside New Zealand that sort of spring to mind, either in Australia or some other part of the world?
Yeah, I'm just thinking of Microsoft, for example. Obviously, they're a very big company, but when we look through their reports, you know, they've been carbon negative since I think about 2012. Carbon neutral. They're looking in the future to actually remove all their historical emissions from the environment, which is pretty amazing. They're setting aside funds to advance technology to look into these problems. You know, they want to replenish more water into the environment than what they're using. They just seem to be going above and beyond, looking at all sides of the kind of ESG framework.
Yeah, and an Australian example, which might sort of be surprising, is Transurban, which is a toll road operator. So when we look at emissions, we look at sort of direct emissions that the company is responsible for directly, and then indirect, which in Transurban case, a large source of that is embodied emissions in cement and steel, for example. And so, you know, they're aware of this and they're working with the Australian cement industry to try and sort of lower the carbon footprint of cement production and have clear targets in place around that, as well as their direct footprint as well. So that's encouraging.
Okay. What about on the social and the governance front? Any either here or elsewhere that sort of spring to mind as being ahead of the curve or doing more than they need to, or that have really impressed you in terms of their social and governance scoring?
I'd probably bounce back to Microsoft again. So when we look into the supplier responsibility, we're looking to make sure that they've got a code of conduct in place with all their suppliers, whether they're flexing any influence over their suppliers. So in Microsoft's case, they want all their suppliers to be on 100% renewable energy by a certain date. They're going in and making sure that the suppliers are treating their workers properly. They're looking at the kind of whole circular economy of their products and trying to reuse products at the end of it, you know, breaking down laptops and getting out precious metals and that kind of thing. So we have to stop the reliance on metals, which in turn is going to stop the reliance on kind of maybe labour practices that aren't so good.
Wonderful. Any that you think of, Roy, in that S or G sphere?
Yeah, I mean, by and large, most companies that we've looked at are good performers, which we'd hope, because we've started with our sort of most widely owned companies and the high quality companies. And we invest in the best companies anyway, so. But where my mind went to when you asked that was just the different ways that companies try and convey how they're performing on certain metrics. And one question we get often is, how do we measure community involvement, for example? And you'll see some companies try and put a measurable sort of a number essentially in place. So for example, Republic Services, which probably doesn't sort of spring out as,
it's the American waste management sort of business.
Yeah, so it's a waste management company in the US. Their sort of community target is to positively impact 20 million people by the year 2030. Or some companies try and put a measurable sort of number on it. Lendlease, for example, which is an Australian property developer, puts that in place to try and, it's just like emissions. Whenever there's a measurable target in place, it becomes a lot more believable, and it's something where performance can be sort of tracked against it, and within the organisation it sort of creates a goal. It's all well and good to say, we want to reduce emissions, or we want to be positively involved in the community, but we can actually demonstrate to investors and the likes of us and to everybody really that you're taking it seriously enough to sort of draw a line in the sand. That's really good to see.
Right. Let's sort of just wrap up with some discussion about how the whole sustainable investing landscape, where it's going sort of in the future, because it's just growing so much and we get asked about it all the time. It's really important to everyone. So I can see us just doing more and more and thinking about it more actively, as all these businesses that we've mentioned will have to do as well. So where do you two sort of see the future in terms of the industry, the financial services industry and sustainable ETFs and funds and just that whole thematic going? Any thoughts on where it might go from here?
Well, one, it's going to continue to grow, from just an investor demand point of view. So, if you look at just in Australia and New Zealand, the amount of funds that are going into ESG products, either passive or active. So passive being just an exchange traded fund, or active through a fund manager. If you look back a couple of years, every quarter it was around sort of $200 million of new funds going towards this space. Now it's well over $1 billion quarterly, and it's just ramped up since COVID. So there's a lot more awareness around this. So it'll continue to grow, it'll continue to develop. But also what's going to happen is it's going to become more formalised. So we're just it feels like we're just at the start of sort of the mainstream sustainability revolution. And companies disclose information very differently. Sort of the only real thing that is sort of directly comparable across all companies is emissions, where everything's sort of on a carbon dioxide equivalent basis, and there's a global protocol to calculate that, and some things around sort of board independence and diversity. Aside from that, it's really hard and subjective, so I'd expect to see more formalisation, more sort of reporting requirements come in. So just like, when you're putting together a balance sheet and an income statement, there's generally accepted accounting practices, some more rigour around sort of sustainability or related reporting. The good example being the TCFD, Task Force for Climate-Related Financial Disclosure Requirements, that are coming in New Zealand from FY23, which is not that far away. Or other examples would be Australia and the UK have introduced modern slavery reporting requirements, which is trying to address and provide assurance that there's board level oversight of supply chains to ensure that there's no human rights violations in supply chains, and there's been talk about that being introduced in New Zealand, for example. So I think it'll just evolve and mature and become a bit more formalised.
And for investors are just it's sort of going to be something where it's like, ignore it at your peril, isn't it? Because when I hear you talking like that, and I think even if some people sort of do kind of write it off as, it's not something that I need to worry about, or I'm just going to invest however I want, regardless, it's actually going to impact you whether you like it or not, isn't it? Because if you've got a growing pool of investment funds and capital that is going to favour the businesses that are doing things the right way, and a lot of companies that aren't doing things the right way are going to find themselves with an increasingly narrow group of potential owners, that's going to be reflected in share prices, isn't it? So, whether you believe in it and to what degree, that's not relevant because it's got a lot of momentum and it's only going to become more important. Is that fair?
Yeah, I definitely think that's a fair assessment of it.
And it's a massive risk. Like, you know, a board's, one of their key jobs is to manage risk for the company, and if you're not on top of this stuff, you know, you're leaving yourself exposed, you know. For example, even from a rising carbon price. So the price of carbon in New Zealand has doubled very recently since a cap's been put on the emissions trading scheme. The amount of free credits that the government is issuing under the emissions trading scheme is getting lower and lower. The price will, you know, almost certainly just continue to rise. And so, yeah, that's a financial risk that needs to be mitigated by itself before thinking of anything, you know, more, I guess, subjective or holistic.
Yeah. Okay, one final one. I know you two are both really passionate about the whole space, like a lot of us here at Craigs are. So, how rewarding has it been to sort of kick this project off and sort of see it through, and to be, you know, taking it to the next level? It must be great to know that you're having an impact on how some of these businesses are thinking and acting, and to, you know, be able to deliver that to clients.
Yeah, I think for me personally, when we kind of posed the idea of doing this project in-house, I was just so glad to see that I could be involved in it. Knowing that we could be influencing companies to make change for the better is, it's a really great feeling. Yeah. Don't know about you, Roy?
Yeah, I mean, to have companies come to us and want a steer in terms of what we want to know and what we want to look at, and use that not only in their reporting, but also hopefully in their own internal processes and things that they should care about, or what you know, are material issues that they should be thinking about. It's pretty cool.
Tells you you're on the right track, doesn't it? When you've got boards and management teams knocking on your door asking for guidance or to be pointed in the right direction. All right, thanks guys. It's been a great discussion. And for clients, for any of our customers, if you haven't already seen the work that we're doing, talk to your advisor, have a hunt around the website. We really do think that we've put together a product that is really thought-provoking, really important, and digs a lot deeper than many other products in this space out there on the market. So we're really proud of it. We'll keep doing more. It's a job that will be never-ending. But it's really important for obvious reasons, but also in a financial sense. So please do make use of it, and please get in touch with us with any feedback or any ideas, and please enjoy this work that we've done, because we're really proud of it. Thank you.